You have $100,000 ready to invest, and the decision comes down to two major ETFs, JEPQ and SCHD. The big question is, which one offers better potential for your investment? In this video, I'm putting JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF, head-to-head with SCHD, the Schwab U.S. Dividend Equity ETF. Both have strong reputations, but they cater to different investment goals. JEPQ is focused on generating income with a unique strategy, while SCHD blends high dividends with steady growth. I'll show you their strategies, review their performance, and in the end, I'll show you how much return you can expect from a $100,000 investment over the next 10, 20, and 30 years. Both offer solid returns, but one has the potential to cross a $4 million valuation and pay over $25,000 in monthly dividend income. The difference in your choice could lead to significantly different outcomes in your portfolio. Let's dive in and see which ETF has the edge. To make an informed decision between JEPQ and SCHD, it's crucial to understand what each ETF brings to the table and how they align with your financial goals. Starting with JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. JEPQ is a newcomer, having launched in May 2022, but it's already caught a lot of attention. This ETF focuses on generating income by investing in NASDAQ 100 companies and then using an options strategy, specifically writing call options, to bring in additional income. Now, what does that mean for you? Well, it means JEPQ isn't just relying on the performance of the stocks it holds, it's also making money through those options, which can be a great way to boost your returns, especially in volatile markets. One of the biggest selling points of JEPQ is its impressive dividend yield, currently at 9.31% over the last 12 months. That's a pretty attractive figure, especially if you're looking for regular income. But there's a trade-off. JEPQ's strategy of writing call options can limit how much the ETF grows in value, particularly when the market is strong and the stocks in its portfolio are climbing. In other words, you might get those steady dividends, but you might not see as much growth in the value of your shares. Now let's switch gears to SCHD, the Schwab U.S. Dividend Equity ETF. SCHD has been around since 2011 and has built a strong reputation as a go-to option for investors looking for a mix of income and growth. Unlike JEPQ, which is relatively new, SCHD has a longer track record and a reputation for stability. SCHD focuses on U.S. companies with a solid history of paying dividends, and it tracks the Dow Jones U.S. Dividend 100 Index. This index includes 100 of the highest-yielding U.S. stocks with consistent dividend payments. And with an expense ratio of just 0.06%, SCHD is one of the most cost-effective ETFs you'll find. This low cost means more of the returns stay in your pocket rather than going towards fees. SCHD's dividend yield is lower than JEPQ's, sitting at 3.46%, but it compensates for this with a strong history of dividend growth. Over the last 5 years, SCHD's dividend has grown by about 12.88% per year, which speaks to the quality of the companies in its portfolio. Another advantage of SCHD is its diversification. The ETF spreads its investments across various sectors, with significant holdings in financials, healthcare, and consumer defensive stocks. This diversification helps spread out the risk, so if one sector is struggling, the impact on your overall investment is lessened. And because SCHD focuses on companies with strong fundamentals and consistent dividend payments, it adds an extra layer of stability. This makes SCHD a solid choice if you're looking for a more conservative investment. Both ETFs have their strengths, and the right choice depends on your financial goals and risk tolerance. Understanding these differences is key to deciding which fits your portfolio best. So now that I've laid out the basics of JEPQ and SCHD, let's look into what's inside these ETFs, their holdings, and how diversified they really are. This is crucial because what an ETF holds and how it spreads its bets across different sectors can have a big impact on both your risk and potential returns. Let's start with JEPQ. JEPQ, as you might expect from an ETF linked to the NASDAQ, has a strong tilt toward technology. In fact, over half its assets, specifically 51.49%, are allocated to the technology sector. This includes heavyweights like Apple, Microsoft, and NVIDIA, which are the top three holdings, making up 7.59%, 6.95%, and 6.92% of the portfolio, respectively. The next largest sector allocations are to communication at 15.5% and consumer cyclical at 12.91%, with notable holdings in Meta Platforms and Amazon, each constituting for over 4% of the ETF's assets. Now, one thing to keep in mind is that JEPQ isn't just buying and holding these stocks. Remember, it's also writing call options on them to generate income. This strategy can provide a nice income stream, but it also means that if these stocks shoot up in value, JEPQ might not capture all those gains. So while you're likely to get more consistent income from JEPQ, you might not see as much price appreciation, especially in a bull market where tech stocks are soaring. In terms of diversification, JEPQ is somewhat concentrated. It holds 98 stocks, and the top 10 holdings account for 43.15% of the total assets. This isn't necessarily a bad thing, but it does mean that the performance of a few key stocks can have a big impact on the overall ETF. If you're comfortable with this kind of concentration and believe in the long-term potential of these tech giants, JEPQ could be a strong choice. But it's something to be aware of, especially if you're looking for broader diversification. Now let's look at SCHD. SCHD takes a very different approach. This ETF is all about dividend-paying stocks, but it doesn't just focus on one sector. Instead, SCHD is spread out across various sectors, with the largest allocations in financials at 17.87%, healthcare at 16.24%, and consumer defensive at 14.62%. The top holdings in SCHD are also quite diversified, including companies like Lockheed Martin at 4.58%, AbbVie at 4.45%, and BlackRock at 4.21%. SCHD's top 10 holdings make up 41.26% of the total assets, which is slightly more diversified compared to JEPQ. SCHD's portfolio includes 103 stocks, and its sector diversification helps reduce risk because when one sector is struggling, others might be doing well, helping to balance out your overall returns. Another thing to note is that SCHD's focus on dividend-paying stocks can provide a steady income, but it's also looking for companies that can grow those dividends over time. This means you're not just getting income now, you're potentially getting more income in the future as these companies continue to increase their payouts. When it comes to diversification within the portfolio, SCHD spreads its investments across multiple sectors, which helps to mitigate risk. For example, while financials and healthcare are the top sectors, SCHD also has meaningful allocations in sectors like industrials at 13.57% and consumer cyclical at 10.66%. This kind of diversification means that SCHD is more likely to perform steadily over time without the big swings you might see in a more concentrated ETF like JEPQ. Now, in the end, I will show you the potential returns from a $100,000 investment over 10, 20, and 30 years from both of these ETFs. Both perform well, but one could reach $4 million and generate over $25,000 in monthly dividends. Now that we've covered what's inside JEPQ and SCHD, it's time to dig into how these ETFs are managed, specifically their investment strategies. Understanding the strategy behind each ETF will give you a clearer picture of what you're getting into and help you decide which one aligns best with your investment goals. Starting with JEPQ. JEPQ is built around a strategy that combines equity investments with an income-generating options strategy. The core of JEPQ's strategy is its focus on large-cap NASDAQ 100 companies. These are some of the biggest and most influential tech companies in the world, and JEPQ aims to capitalize on their performance. But what sets JEPQ apart is its approach to generating income. In addition to holding these stocks, JEPQ writes covered call options on them. So how does this work? Essentially, by selling call options, JEPQ collects premiums from buyers who hope the stock's price will rise above a certain level. If the stock doesn't rise above that level, JEPQ keeps the premium as income. This strategy can generate consistent income, which is why JEPQ's dividend yield is so high. However, there's a catch. If a stock in JEPQ's portfolio does shoot up in value, the call options might cap the upside, meaning JEPQ won't capture all of that price appreciation. This strategy works well in sideways or moderately rising markets, where income from options can boost returns. However, in a strong bull market, JEP's growth might lag behind other ETFs that don't use the options strategy. It's also worth noting that the option strategy adds a layer of complexity and risk, as it involves betting on stock price movements. If you're someone who values high income and can tolerate the potential for limited growth, JEPQ's strategy could be a good fit for you. Now let's look at SCHD. SCHD takes a more traditional approach, focusing on long-term growth and income through dividend-paying stocks. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which includes 100 high dividend-yielding U.S. stocks. The selection process for these stocks is based on several criteria, including dividend yield, dividend growth rate, return on equity, and cash flow to debt. This means SCHD is not just looking for companies that pay dividends, it's looking for companies that are likely to continue growing their dividends over time. SCHD's strategy is straightforward. Invest in financially strong companies with a history of paying and growing dividends. This focus on quality helps SCHD offer a more stable investment with less volatility than a tech-heavy ETF like JEPQ. The companies in SCHD's portfolio are typically well-established with strong fundamentals that can weather economic downturns. This makes SCHD an attractive option for investors who prioritize stability and consistent income over high-risk, high-reward strategies. One of the key strengths of SCHD's strategy is its potential for both income and capital appreciation. While the primary focus is on dividends, many of the companies in SCHD's portfolio have also shown solid price appreciation over time. This makes SCHD a more balanced choice if you're looking for an investment that can provide both steady income and growth. So based on these strategies, let's see how they've performed in the past and what the future looks like for these ETFs. Starting with JEPQ. JEPQ is relatively new, having launched in May 2022, so its historical performance data is somewhat limited. However, in the time it's been on the market, JEPQ has shown a decent return. Over the past year, JEPQ has delivered a price return of 12.67%, which is quite strong, especially considering the volatility that tech stocks have faced recently. The combination of holding NASDAQ 100 stocks and employing an option strategy has allowed JEPQ to generate consistent income while still capturing some of the upside from its underlying holdings. One thing to keep in mind, though, is that JEPQ's performance is closely tied to the tech sector. This means that during times when the tech stocks are underperforming, JEPQ might also struggle. However, its strategy of writing call options can help mitigate some of the downsides by generating income even when stock prices are not soaring. This makes JEPQ a compelling choice for those who are bullish on tech but still want some protection against market downturns. It's also important to note that because JEPQ is so new, we don't yet have long-term data to see how it performs across different market cycles. But if its recent performance is any indication, JEPQ seems well-positioned to deliver strong returns in a variety of market conditions, particularly for those seeking income. Now let's look at SCHD. SCHD, on the other hand, has a much longer track record, having launched in October 2011. This gives us a lot more data to work with when evaluating its historical performance. Over the past 10 years, SCHD has delivered a remarkable 112.11% price return, which averages out to over 11% per year. In the past year, SCHD has returned 11.86%, which is slightly below JEPQ's performance, but still impressive given the broader market conditions. But is growth alone enough to make JEPQ a winner? In the end, I'll show you which ETF will cross a $4 million valuation and pay over $25,000 in monthly dividend income. SCHD's diversified approach, focusing on multiple sectors like financials, healthcare, and consumer defensive stocks, has helped it perform well across various market environments. Whether the market is booming or facing challenges, SCHD's strategy of investing in financially strong companies with a history of paying and growing dividends has proven to be a solid approach. One of the strengths of SCHD's historical performance is its ability to provide both income and growth. Over the past 10 years, SCHD's dividend growth rate has averaged 11.01%, which is impressive and speaks to the quality of the companies in its portfolio. This combination of capital appreciation and dividend growth makes SCHD a strong candidate for long-term investors who want to build wealth steadily over time. Now that we've got a solid understanding of the strategies and performance of both JEPQ and SCHD, let's look into what a $100,000 investment in each ETF could potentially grow into. This comparison will give you a clearer picture of how these two ETFs could impact your financial future, taking into account both capital appreciation and dividend income. Starting with JEPQ. It has a current dividend yield of 9.31%, but due to recency bias, let's assume it maintains a 5% yield for the coming years, with a dividend growth of 6%. Additionally, since inception, it's had an average share price appreciation of 4.22%. Based on these metrics, in the first year, your investment would grow to $109,219. Over a 10-year period, this investment could increase to $250,988. Looking further ahead, after 20 years, your $100,000 investment in JEPQ could grow to approximately $692,719. By the 30-year mark, the value could reach an impressive $2,138,785. This figure includes $744,433 from capital appreciation and a substantial $1,294,352 from reinvested dividends. After 30 years, you could be receiving around $13,210 per month in dividends, totaling $158,516 annually. The big question is, can SCHD beat that? Let's find out. If you decide to invest $100,000 in SCHD, how does it stack up over the same period? With a current dividend yield of 3.46%, a higher dividend growth rate of 11.01%, and a stronger average share price appreciation of 7.89%, SCHD offers a compelling mix of income and capital growth. In the first year, your investment would grow to $111,353. Over 10 years, this amount could triple to $307,293, driven by the robust price appreciation and reinvestment of dividends. After 20 years, your $100,000 investment in SCHD could grow to approximately $1,072,360, more than doubling the 20-year value of JEPQ. By the end of 30 years, the value could reach an extraordinary $4,436,968. This total includes $2,295,808 from capital appreciation and $2,041,160 from reinvested dividends. By then, you could be earning around $26,783 per month in dividends, totaling $321,394 annually. When comparing these projections, it's clear that SCHD offers superior long-term growth, both in terms of capital appreciation and dividend income. After 30 years, SCHD's total value added to your portfolio could be more than double that of JEPQ, with a total value of $4,436,968 compared to JEPQ's $2,138,785. If your priority is to maximize income in the short term, JEPQ's higher dividend yield might be more attractive. However, if you're looking for a more balanced investment with significant long-term growth potential, SCHD's historical performance and stronger growth rates make it the more compelling choice. Want to turn a $100,000 investment into over $10 million? Click the video on the screen to find out how it's possible.